What up, gang? How's it going? So I am pulling my hubby in, who is I don't know, wealth management, financial advisor. What the hell do you do, honey? No clue. Something like that. But I wanted to bring him in and share his expertise. I've been listening to him talk to his clients, obviously nonstop over the last 3 days as we've been in house quarantine. And I just felt like the information that you were telling them, I was like, wow, that's interesting. Like, I feel like this is stuff that a lot of people have a ton of questions. So we asked you guys what questions you have. We're going to be talking about 401k, stock, real estate, refinancing, early investors, no risk, low risk, CDs, the future of the market, how long we all the things. So let me introduce yourself, honey.
I'm the husband, also known as Hunter. I kind of lurk in the background. So I work with MCF Advisors. I am a financial consultant and really have an emphasis in as a retirement planning specialist. And it's really funny that it takes a market crash and us being stuck together for her to take interest in my work. Anyways, I'm glad to be here. It's a very stressful time, really, for everybody. And part of our job, it really as advisors and consultants, is really just to be a steady hand of leadership. And as I tell people, become a psychologist during these times and really try to talk people back from the ledge. There is a lot happening, and what happens is it moves at such a breakneck pace when we have the velocity of money moving like it is right now. So how do we get here? First, last year was a really great year, and really, honestly, it's been a really great about 8-year run minus 1 year in the markets. And it's very easy to get complacent and kind of feel like, man, this thing's just going to keep going up forever. The reality is that markets and economies don't necessarily move hand in hand. Occasionally stuff happens. The same thing happened during the Spanish flu. There was still market and trading, and from a historical standpoint, we've had about 8 events that get close to 50% reduction over the course of history, this being the 8th, if we get there. So obviously it's been very volatile in the market, and a lot of people at that time, they just kind of get fixated on looking on their accounts. Let's start with 401ks and kind of go from there. There's 2 different things that we're talking about when we learn and are talking about risk and volatility. Volatility is what we're experiencing right now, being the ups and the downs of the market. And in this case, it's really big moves, and nobody, including us in this business, is really used to that on a normalized basis. We've had 9 straight days. I think today we didn't hit 1,000, but going in today, we had 9 straight days of 1,000-point moves in the Dow or more. So I would temper the expectation that we're hit bottom and that we're done, because I think we could go lower. Lots of reasons about that. But let's start with the risk of your 401k. The reality is it's broken up into 2 different phases of your life, and that's your contribution phase, your saving phase of your life, as well as your distribution phase. When we're saving money in our 401ks, risk doesn't matter very much, quite honestly. And so what I mean by that is when you have a lot of time ahead of you, the market is going to cycle up and down. And over the course of your career, you're going to be buying in when the market is high, and you're going to be buying when it's low, and it's going to average out over time. In periods like right now, if you had extra money, ideally you would save more because you're buying on a big sale. I like to tell people all the time that, think about something you like to buy in your life. Shoes, for example. Amanda likes shoes occasionally. She's actually a very thrifty person, and so she very rarely would want to pay, unless it's something she really wants, full price. But if she goes in and she sees it's 20% off, something she passed on before, she's likely to think about it a little bit more. In this case, we might be getting to like 40% off. And it's the same great products and great companies that we use every day. So that long-term focus is really important. There's two factors to what your 401k savings will look like at the end of your retirement. And the first one is your savings rate. That drives number one. How much you put in every paycheck and over the course of time matters number one. Ideally, as a whole, with what your work is matching you and what you're putting in, should be over 12%, 12 to 15% from the earliest stage possible. The second impact of what your retirement savings looks like is investor behavior. And this is like the period when investor behavior really matters. What is investor behavior? That is not, honestly, it's an all-encompassing thing, but the simplest way I can put it is not making the wrong decisions at the wrong time. And because when we manage our money, there's an emotional component to it, we tend to try to time things. And really, that's a horrible strategy in the grand scheme of things. And I'll give you an example of why that would be. But the reality is that that emotionally we get driven to make a decision, and we're either behind the curve, like, now that the market has already fallen over 30%, and we make that decision, and maybe you got it right and pulled it out and it starts to go up, where you've missed the participation of the markets. I like to say we can't time a market, and I know this is stuff that you've probably heard, but I'm going to kind of tell it to you again. When you try to time the markets getting in and getting out, you have to be right twice. You have to be right when it goes down, you're getting out at the right time, and then you have to be right when you're getting back in. And no offense to the masses out there, but no one's right twice in this business, on a consistent basis when trying to time it. The best example I can give you is from, and I'm not cherry picking, like there wasn't a crash during this time period. From 2004 to 2015, a 10-year period, if you were fully invested, you would have made 70% on a growth portfolio, not counting reinvested dividends. And that's 70% of whatever you had in there, okay? If you had missed the 10 best days, just 10 out of a 10-year period, your account would have gone from being up 70% to being down 14. If you had missed the 20 best days during that time period, you would have almost cut your value in half. And there's reasons for that. The 10 best days often come within a very short time of the 10 worst. So we can't possibly figure that out. So what do? Well, the reality is we manage our risk appropriately. So I told you before, when you're saving, that risk doesn't matter. But when you get close to retirement, it matters. And when you retire, it really matters. So general rules of thumb of what you can look for. It's fine to be aggressive, in my opinion, depending on your personal situation. But it's okay to be aggressive. But as you approach retirement, and I define that 12, depending on where the market is, 12, 10 years from retirement, whatever that window is, you should be rotating and becoming more conservative. So if you're aggressive, let's say you're 90 to 99% in equities, you need to be more like 70% in equities, 30% in bonds or fixed income. As you get 5 years from that, it's generally best case scenario to be 50-50. And then from there, when it goes to distribution phase, there's some more calculations that need to be done based on your income needs. So let me tell you how that would compare. I've had lots of calls. She's heard me. There's a gentleman who's 65 that called me this week. And it's relative to everybody. This is upsetting. And I wasn't in front of my computer and couldn't look him up. He's a 401k participant in one of the plans that we serve. And he was 65. And the way he was talking, it made it sound like he was taking too much risk. And I was like, man, this is unfortunate. And it turns out he wasn't. And he was upset, and he was down 11%. And there's nothing, listen, 11% is 11%, because he was just worried that it will never come back. He's managed his risk appropriately. There's a big difference of being 65 and losing 11% and losing the 30% or so that we're in today. So I would say manage your risk as you approach retirement, and let's not try to time the markets, particularly in the 401ks. So that would be the first thing.
And so basically, do not pull your money out, right?
No, don't try to flee to cash. And it's funny because the market has been doing this for the better part of almost 3 weeks now, but my calls have really just ramped up in the last 4 days. So starting on Thursday, Friday of last week through this week, well, there's been a ton of damage done before these phone calls have done, which just is kind of, a further illustration of that. So I'm not a big fan, particularly when the market's already made a move. I am a fan of managing your risk appropriately. And there's ways that you can be a little bit more efficient in this. So I'm not telling you to do nothing. So one thing that we can do is rebalance our allocations. In a perfect world, every investment, if you think about it as a pie, and you've got different, hopefully if you're well diversified, you've got different pieces of your pie, and they all do different things. In a perfect world, they would all grow at the same rate, but they don't. Your aggressive stuff tends to grow faster and bigger. So last year, that would have, if you did nothing and made no changes, your aggressive stuff would have been up 25 to 30% last year, which changes how much of the piece of your pie that is in. Okay, you understand that?
Yes.
So if she can understand it, anybody can understand it. So what we can do on a regular basis is rebalance in our allocations and make that more orderly. So an example of that in portfolios that we did, we had a really great year. In January, we were moving them 5 to 7% from equities, from stocks, both international and U.S., and putting those into bonds or diversifying strategies that don't carry the same volatility. They don't give you the same return in today's, but that's not necessarily the function. It's kind of a law of averages. We thought there would be a pullback at some point in time. Didn't think there would be a crash, but here we are. Consequently, rebalancing is not just for when you make money. So now we are in a position where the market has dropped. If you own spaces in the safety or fixed income in terms of bonds, diversifying strategies, stable value funds, those kind of things, then it might make sense for you to peel off a small piece and look to put in the equities, at present time or over the next few weeks as you feel more comfortable, because the U.S. market, broad market, is down 30%. The S&P is down 26.5%. So what should you put it in? I'm a big fan of buying the index versus going to find a managed mutual fund. The indexes are very low cost, and right now there's a huge opportunity. So part of the questions that we're kind of pairing questions together here, but do I think the market will bounce back? And without a doubt, I am going to tell you 100% yes. If we maintain long-term focus and don't make problems for ourselves in this matter, it will bounce back. I'm not meaning to twist it by saying it's not going to be painful. The market tends to move ahead of the economy. So the economy has been very good, and now this has happened. The market has been falling rapidly because it understands before, honestly, even us as advisors, because we only get information little bits at a time. Last week, we didn't think there was the possibility that every restaurant was going to be closed in town. We didn't think that our hair salons and gyms were going to be closed in town. We didn't think that the hotel business around the country would be completely decimated and that airlines would almost stop traveling. All this stuff, we might have thought it in our minds, but it wasn't a certainty. It wasn't coming from the government. We knew it would have an impact. But Wall Street has a tend to be far ahead in that scenario. So a lot of what is happening now is built out farther past what the peak of this virus is, which will make more fear and more worried amongst our friends and neighbors. The good news is that when we rebound, Wall Street tends to be ahead of when their economy is actually starting to get better. And then, of course, times like these, the government intervenes. They put together a lot of stimulus. We've cut rates, and those things have a long-term effect.
So is there any way to predict how long it's going to take for us to get back?
There's really not. So you remember I used that scenario from 2004 to 2015. Well, in the middle of that in 2008, we had one of these. it was for entirely different reasons and entirely different circumstances. And the worries that we had then are vastly different than what they are now. The foundation of our financial system was totally at risk before, and it is very solid. Our banks are healthy. Our big companies that you use and love every day are flush with cash. So not everybody is struggling, but everybody's going to take a hit from this. But it's a whole lot easier from a company, versus in '08, like Apple, that we probably use every single day. I know she does. I know I do. Apple has $1 trillion of cash on hand. They've closed every one of their stores and they're paying every one of their people through this. They have the ability to do that. Not every company does, but there are big companies out there that are in a better situation than they ever have been. Where we're going to really feel this is in our neighborhoods, because small business is going to get really beat up, if not worse, from this. And that emotionally affects us in this business, because we have friends that have small businesses and they're all being impacted. And, all we can do is kind of hold on and support those kind of things. And hopefully the aid from the government will be meaningful enough and get there quick enough to maybe stop that bleeding at some point in time. The last thing I would tell you about markets, and the reason I'm not worried, is because you can pick a time, you can pick any point in history and go 30 years, any single point. I'm not cherry picking, literally anywhere, and go 30 years, and the S&P 500 and the market has never not returned a positive return. And it's always close to 10% at that point in time, not counting reinvested dividends. So if we're long-term in focus, then absolutely it's a great time, a huge opportunity if you have extra money to put it in right now, and we will be in good shape. If you're older and you can't take that risk, then there's small bits that you can move. And that's more of a personal conversation that she can give you contact information that if you want to bounce some stuff off, that we can talk that. But when you're already retired and your horizon is there, you're not done investing your money. You're done taking risk, but just because you're done taking risk doesn't mean you're not going to be exposed to like the stock market in smaller chunks. Because you have, if we knew when we were all going to pass away, this would be easy. And so you have to try to figure out to make your money last the duration of your life. And for some people, that's in their 70s, and other people, that's closer to 100. That's kind of the juggling game that we have. And so we take distribution phase a little bit differently, and we're income planners in my office. What else can we talk about? So
Stocks.
So is there anything?
Buy.
Yes.
Sell.
Yeah, I mean, in taxable accounts, I think the opportunity is just as good as it is in 401ks and IRAs. If you're starting out and you're brand new to this, the simplest way for me to tell you right now and have a great value and an awesome opportunity is go buy the S&P 500 index.
So new investors, younger people.
Yeah, just buy the index. If you have a chunk of money, you could put it in at once, or you can leg it in over a period of time known as dollar cost averaging. And all that simply means is, let's say you had $10,000, but you're worried to put it all in because you heard what I said, that we're probably not at the low yet, in my opinion, and that's all it is. I tell people all the time, if I had a crystal ball, I would be doing this on my private island. So there is no crystal ball to this, and we don't know for certain. But all I can tell you is from a historical standpoint, it's a really good opportunity. And I would just buy the index. The index is cheap, and it will perform. And you get diversification built in it because you have a lot of companies, both old and newer. The bottom half or the bottom small piece of the S&P 500 replaces itself a little bit, but the top are the ones that have been there. The Caterpillars, the Johnson & Johnsons, the P&Gs, the Apples, the Googles, the Facebook, Netflix. All these are huge companies that influence
So
us.
versus like if you're young, versus like cherry picking, like Zoom, or I don't know, some of the companies that you think are going to really cash in on this time, just do that.
Well, here's the thing with that. We're investing for the long term. If you had a big chunk of money, that's definitely a one way you can do it, because you can buy more companies that don't necessarily correlate with one another. When you don't have as much, I'd rather give you the diversification over time and tell you to buy the index. there's no right or wrong answer with that. But if you go out and take your $10,000 and bet it all on one company, even though the value is still good right now, and there's other factors that you would have to look at that. Amazon is still trading, at a higher multiple of its earnings. So you might not be getting a good as value as some of the other companies. But the point is, at the end of the day, you're taking more risk because there could be something that individually in the next 4 years or 3 years or whatever that occurs with that company and causes it to have a problem versus the index. If one or two companies have a bad year or two, it's not going to affect the entire index in whole, if that makes sense. If I were young and starting, I would look at the index.
What if you're not young?
Then.
But if you have like extra cash right now, what's going to be the best? Is it reinvest in your 401k? Is it buy stocks like you're saying? Like what's going to be the best use of that extra money to get the biggest return?
Well, first of all, I guess, that question begins if you're going to have a taxable account and a 401k that work differently. Your 401ks are either pre-tax or you can do the Roth. If you're not maxing that out, and there's a reason of why you're not, because you don't have to pay tax on the money that you're putting in there, income tax. So I would probably start there and put more money in as a contribution, and then even if you're more conservative, let's say you're 55 or 60, but you have the ability to up, you're not maxing out, and you have the ability to up your contribution, then put your contributions up, leave your allocations the same, but at least buy the equities right now, change what you're putting it in and leave everything else the same and still get some opportunity going forward. As far as, an investment account, a taxable account, there's no right or wrong answer in terms of that. The difference is that then it becomes a little bit of, when it comes time to sell, you sell, say you make some money on it and you sell it, you sell it, but you will be taxed on whatever you made in terms of that. But then that's where you have to look at other holdings in there. Maybe you sell some for a loss and some for a gain and offset those. A little bit longer of a conversation, quite honestly. Someone had a question on real estate in here, and if I thought it was going to impact that. The answer is yes. It depends on what real estate we're talking about. If you're talking about your house, the nice thing about living in the middle of America, kind of like where we're at right now, is we don't have a lot of really big swings one way or the other, even when the economy happens. 2008, the real estate bubble popped, and we did drop a little bit here, but it was very small comparatively speaking to the East Coast, West Coast, and Florida. So we're not as volatile in that standpoint. Where it will affect real estate for your house is that because the economy is going to be really put to the test, and we've got more people that are going to be unemployed and small businesses that are going to fail, is that the amount of buyers are going to shrink. So inventories will tend to go up, which makes things honestly a little bit more competitive. So from that standpoint, it will have an effect. How much, it's really impossible to tell. However, if you're in a house and you don't have any plans to leave, and let's say you've had a mortgage 5 or 6 years ago, it's probably a good time to at least look at what your rate is and see if you can capture any savings on a refinance. If you are in a stable situation and you've been thinking about doing a project and you have the ability to do that, which will increase the value of your home, maybe you need renovation, it's a good time to look at that from a refinance standpoint to get a little bit of your home equity to do that, because rates are tremendously low again. And that opportunity, they've been low for a while, but they spiked up and now they've dropped back down. So it's just another opportunity from that to either save money and help your budget at home, or maybe do that project, or those kind of things. From a rental real estate standpoint, there's lots that's going to be that this could affect. But again, there are different scenarios. Hopefully we get past this and school starts and people will be moving back into dorms and rental properties. But anytime there's an abundance of inventory, that usually bumps up the rental market. So sometimes that helps as less people are looking to buy, there'll be more people to rent. So it's kind of a two-way street with that as well. Any other things on real estate?
Well, somebody asked about CDs. Did we talk about that?
No, yeah, I was going to get to that.
Yeah. Oh, real estate. No, I think that's I think that's pretty much the thing about real estate.
So here's what I would say about CDs and really bonds for that standpoint, and we'll finish up because we're running a little bit long here. But if you don't know how CDs or bonds work, a CD is where you open up an account. You're essentially loaning the money to the bank, and they pay you an interest rate for that money over a period of time. The same thing kind of works with a bond, by the way. A bond, you're loaning it to a government or corporation, and they're going to pay you a rate, and if you hold it for the amount of time that bond is for, that's what you will earn on your money. Bye. CDs are safe. There is risk, and I don't want to confuse people to say that there's not risk in CDs. It depends on how old you are. People get comfort by knowing that they've got the FDIC that is going to cover it, but honestly, the risk of the CD is the health of the bank. I don't think we have any big problems with that these days, so that's not a huge risk. But the real problem is that fixed income instruments like CDs and bonds are not yielding what they used to 10 years ago, even 5 years ago. And so at the moment, there's not much inflation, but they're not paying very much. So the reality is you're not probably likely to pace inflation, which is a problem over time. It's not in the short term. The Fed's target for inflation is 2.25%, and we're not there right now, by the way. But inflation is real in our lives. Things tend to cost more money over time. Should you put that money in the market? I'm hesitant to tell the person who asked that question to do that because they are two totally different risk scenarios. And if you're not ready to stomach that, and depending on your age and that your use for the money and those kind of things, I would tell you not worry about that. The real challenge you're going to have is with a CD is how long to put it in for. Those things run from 12 months or really 3 months in some cases to 5 years. 5 years they should pay you more, but the spread between those is very small. So a 1-year CD, I think you're looking at just over 1%. Which is better than sitting in your checking account. So if you're wary of risk, then absolutely go do that. If there was another option that I could give you that were foolproof in the time being, then I would. The aggregate bond index is probably going to look between, 1.8 to 2.4, 2.5 over the next couple of years. So bonds probably will bring you a little bit more. And they look like, if you have bond funds in your portfolio, they look like they've done better. And they've done okay, but what you have to realize is the price of bonds move versus CDs don't. And what I mean by that, we had a rate cut, actually had 2 this month. When interest rates go down, the price of the bond goes up. It's an inverse relationship. When they raise rates, the price of the bond goes down. If you hold your bonds to maturity or the fund holds it to maturity, you're only going to get what the rate is, and what you've made in the short term or what it looks like you've made is going to get amortized over time. A little confusing, but still a safe investment by and large. Defaults are still very low. Corporate America seems to be pretty strong at this point in time. And the function in today's environment is not necessarily 100% return. It'd be nice if we could get 4% in bonds. It's a function of safety at this point. So that's where you need to manage your risk a little bit.
All right. Okay. Well, I think that's all the questions. Okay. So basically, no knee-jerk reactions.
Please don't.
We got to write it out.
Unfortunately.
We need to look at, basically, if we need to assess anything, we need to look at our distributions and our risk assessment, that kind of.
Yeah, I think you need to manage your risk. And if you're one of those people that hasn't and you're getting close to where those dates that I said you should. So maybe you're 50 and you're still aggressive and you think that you need to reduce that. I would still wait. I would wait a little bit because I think where we're at is still somewhat of a temporary measure. My worries my worries that were at the beginning of the year have completely changed. So our market has been on such a run that we reallocated and moved some money to take to take advantage of the situation a little bit, and we only do it in very small chunks. But the reality is that I did have worries on entering in a period of decline, because, quite frankly, we're due for one cyclically. And so we were making adjustments within our financial planning programs and softwares for the next 5 to 7 years of reducing what our long-term returns would be for basically people in that range. And now we don't have that fear. The values of the stock market are a much more desirable spot. So I would not adjust your risk in the middle of this. I would get past it. And then as you see some bounce, let's start making some decisions. And then in the meantime, though, rebalance, take advantage of rebalance,
yes,
take advantage of what you have at the moment and look at your allocations.
If you are young, it is a good time to think about retirement if you haven't been.
Well, it's always.
Is that what we're saying? The people asking about early investors.
Yeah, if you're early, it's never too young to start, even with small dollars. What I would tell you is that if you wait, and the younger people have different challenges than we did. People are coming out with much more debt than what we're blessed people, but people are coming out with much more debt, and so they feel they can't save for retirement at this time. And some of that is absolutely true. But what I would tell you is the longer you wait to commit, even the minimum to get the maximum match or wherever you're working, the longer you wait to start that process, the harder it is. And the more it costs you over your lifetime. Meaning you're going to have to make more sacrifices in the future, pulling more money out of your discretionary income to put toward that, which is, again, it's a sacrifice that you can start earlier at smaller numbers and be much better off than you are starting later at bigger numbers because it costs you more ultimately in the long run. So yes, start, get going. It's a huge opportunity, and don't be afraid. I'm really big on people. If you're not an aggressive person, you don't have to be in an aggressive index or an aggressive investor. Life's too short to be anxious about this kind of stuff. But that being said, if you're young and that doesn't bother you, you have time on your side. Be aggressive and take advantage of the market's given you at this point. So.
All right. Hopefully we learned something. I know I've definitely learned a lot. If you have more questions for Hunter, ask those in the comments below. If you want to talk to him one-on-one about your individual stuff, DM me and he can set up a call and, help you out. So hopefully we can all wade the storm together. Yeah.
Yeah, something.
Yeah, so, all right, guys, thanks so much. See you soon. All right, perfect.